Accounting Standard 2 Valuation of Inventories. So in this section, what we do is we will take a look at the different types of inventories, cost ascertainment, which is done on those inventories, and the application of cost formula, valuation of inventories. What are the different types of valuations which we have? Accounting standard, which is prescribed in the case of valuation of inventories. We will briefly explain what it is, and we'll take an example to illustrate what is valuation of inventories. So as explained, we will go through types of inventories, cost ascertainment, valuation of inventories, measurement and cost of inventories, cost formula, techniques of cost measurements of inventories, and then there is a problem or case study. So we will first see what are the types of inventories. So in any manufacturing concern, we have inventories which comes in from the suppliers in the form of raw materials. In the manufacturing sector, what we do is we work on those raw materials and we convert them into finished goods. At any given point of time, there will be some raw materials which might be under manufacturing process. So that becomes work in progress. So essentially, the different types of inventories are raw materials, finished goods, work in progress. Now, what is cost ascertainment? Value of stock in terms of periodic inventory and perpetual inventory. So that is cost ascertainment. What is periodic inventory? In periodic inventory, we do take a physical count of inventory at specific intervals of time. So that stock taking is actually the periodic inventory. In perpetual inventory, what happens is that we do this activity based on electronic records and also on the basis of continuous estimates of inventory, and that is what is perpetual inventory. Now let us see what is valuation of inventories. So according to Schedule 6 of Companies Act, inventories are shown under current assets and are classified as stores and spare parts, loose tools, stock in trade, and work in progress. So mode of valuation is set according to the item which we actually consider. So the earlier methods of valuation of inventories permitted a variety of cost formula for inventory valuation, namely FIFO, LIFO, average base stock method, and adjusting selling price. We'll also see what each of them means in the spreadsheet program, which we discuss later. But typically there is FIFO, which is first in, first out, which is a cost formula which we apply for valuation of inventories. Now, after that, we have LIFO, which is last in, first out. So we will see example of both of this in the Excel spreadsheet. The valuation methods adopted according to the revised standard of valuation of inventories is FIFO, or weighted average cost formula, for determining the cost of inventories. For cost of finished goods, the revised standard on valuation of inventories permits only absorption costing method for arriving at cost of finished goods. Now let us quickly take a look at an example which we have based on Excel spreadsheet. And that is a record of receipts and sales of certain goods during the first week of April 2008. So here what it is told is that on 1st of April 2008, the opening stock was 500. And for each unit in the inventory, the rate was 8 per unit, 8 rupees per unit. So there were 500 units and 8 rupees per unit is represented as 500-8-4000, which is 8 into 500 is 4000. So that is how we actually denote a balance. So the first item is that we have on 1st April opening stock, which we represent by 500-8-4000, which means there are 500 units. Each unit price is 8, and then there is a stock worth of 4000, which is the opening stock. Now on second, there is a purchase made. That is what is here, purchase made for 600 units at 10 rupees per unit. Okay, so that how we indicate, we indicate it by 600 units dash 10 dash 6000. That is how we indicate. So that is a receipt. Okay. So at the end of the 2nd of April, what we have as balance? We actually have 500 units at rupees 8 per unit, which is 508-4000. And then on second, we made a purchase of 600 units at rate rupees 10 per unit, which is 600-10-6000. So these two will be indicated as balances. So here it is purchases, so we will be actually adding it after whatever is the opening stock. Now, if there are sales which is there, we will also indicate that. That is what we next indicate by next. This is FIFO actually. So on third, we have a sales of 300 units. Now, at what price? The price will be at whatever is available as balances. So there is no specific price for this actually. Whatever stock is available, we will get to know the price from them. So actually on 2nd of April, we had as balances 500 units in the opening stock as well as 600 units which we purchased at 10 rupees 10 per unit. So there are two batches of inventory which are available. Now on 3rd of April, we actually are trying to sell, or we have sold 300 units. Now how that 300 will be taken from the balance, that is shown in this in 3/4/2008. We know that there is an issue of 300 units. Now in first in first out, we have 500 units as well as 600 units. So which of this batch we will first take? That is the question. Always in first out, the first unit will be taken. So that would mean from 500, from the batch of 500, we will be deducting this 300. Okay, and then there is also 5 units which is verified as a loss on 3rd of April. So there is, so on the issue side, there is a item 5 loss and then there is 300 units which are sold actually. So how we would take this is, we will first deduct 305 units we have to deduct. Now from which batch we will deduct? We will deduct it from the first batch because it's first in first out. So from 500 units we will deduct 305, 300 units which we sold plus 5 units which are loss units. Which got damaged or which is not useful on 3rd of April. So 305 units will be deducted from 500, not 600, 500, the batch of 500 units. And there's a price to that. It is 8 per unit. So from 500, if you deduct 300, we get 195 units and that is what is the balance, because 305 units are gone from the batch. So 195 units we have at a price of 8 per unit. And this is how we normally do all the other balances. And from on down 4th, if you really see, there is a sale. Well, on 5th, there is a sale for how many units? It is 400 units. So on 5th, there is a sale for 400 units. Now on 4th, we know the balance. 195 units are there at 8 per unit, 600 units are there at 10 per unit, and 100 units are there which we purchased on 4th at 10.2 per unit. So all these three are there, and on 5th we are trying to again deduct 400 units. So from where the 400 will go, we will first take 195 units of 8, then we will take 205 units from 610 at price 10 per unit. So that is how the 400 units is made up of. So always we will take a look at the stack of the balance and we will take whatever are the first items. We will exhaust that and then only we will come to the next stack of units. So that is first in, first out. For LIFO, last in, first out, it's just the opposite. So from the balance, for example, we will consider 3rd of April 2008. There is 5 loss, and then there is 305 is the number which we have to consider. So from where we would actually take it? We would take it from the last one, that is 610, 6000. From that stack, we will actually deduct 305, and that's why in the balance we are denoting it as 295. So whatever is the last, we will take it. So prices also may vary. So there is a significant variation in price. If you take a look at the cost of goods sold and valuation of stock, we know that the cost of goods sold, it is 10,011, whereas in this case, in the case of LIFO, it is 10,760. So it is more. So there is a difference also in cost of goods sold as well as on the loss of units. Loss of units remains the same, but the pricing would be actually different, whatever is remaining. So this is basically what is LIFO and FIFO, and the records, how we consider from the balances, how we deduct the issues which we have made, or sales issues which actually goes from this unit. So and now we will take a look at what is accounting standards valuation of inventories. So as was explained, the standard deals with values and determination of values at which inventories are carried until related revenues are recognized in financial statements. It also determines ascertainment of cost of inventories and net realizable value, which is any written down value or inventory value written down to net realizable value. As per the standard, the inventory should be valued at lower of net realizable value or cost. For goods which are ordinarily interchangeable, FIFO or weighted average cost method can be used. So this standard does not permit direct costing method for inventory valuation. For manufactured goods, it mandates the use of absorption costing method as the preferred means of valuation.